This is Eric for XPlain. For the first episode of what makes this market crash great, and we're going to talk about a very recent one since we're at the end of March 2022, 7 and 8th of March 22, short squeeze. Now you're going to argue that this was not a market crash because the market went up 5 times, but actually when you're talking about bankruptcy, systemic risk, you're definitely talking about market crash, and also this was absolutely an extreme event, an incredible one. So we're going to go through this, explain why a short squeeze happens, and then we're going to go specifically why this one happened and the consequences as we know them now. So what actually happened? First of all, we're going to look at a tick-by-tick chart, so second-by-second or trade-by-trade chart of what happened during these 2 days. You can see the price going up 5 times over these 2 days, which is just incredible. And there's a gray area there, which is trades cancelled by the LME. Trades later cancelled by the LME. So the trade took place during that period, and then they were cancelled afterwards. By the London Mercantile Exchange. This is just extraordinary. And why would they push to take that decision, which is really a really difficult decision to take, but it must have been better than any other thing that they would have done. In this case, let the market trade. There are a lot of extraordinary things about this graph. We're talking about an industrial commodity, not some meme stock that just goes up like this and deflates afterwards, or in NFT or whatever you can think of. This is industrial metal. This is nickel, which you can find in all sorts of very useful applications, like these guitar string or these wonderful knives. And electric vehicles. And that was one of the reasons why this came to be indeed, but this is not a trivial asset. And it's very rare to have these multiples in a commodity. But in natural gas, it happens, if not often, at least regularly, especially in the winter, November, December period, when the expectations for cold weather actually changes. In one way or another, and you can have these big spikes, as you can see. But nickel, it's a boring metal that's been, as you can see, its price has been stable over long periods of time. Except that you see that 06-07 period, which is when China started to need a lot more commodity and the price went up. But it happened over the course of months and weeks. There it happened in minutes. So what happened? Well, what happened is nothing but a short squeeze, a pretty massive one, which is why it would qualify it as one of the greatest market crash ever. But this one is a textbook short squeeze, and they always have the same pattern. There are 3 stages that are necessary for a short squeeze of any scale to happen. The first thing is that you need a bearish positioning. You need a reason to be short, and to be short in size, 20, 30, 40% of the market to be short. Could be anticipation of an event. It could be just a valuation mismatch, maybe an upcoming announcement or actually a fraud. Anything that motivates some portion of the market or some market participants which are strong enough, big enough to have a very significant short exposure. The other thing you would need for the price to go up, like we're seeing now, is in multiples over a very short period of time, is obviously someone forced to close its short position, which obviously means buying. So you need a forced buyer. You need the pressure of the price being so high that the short position needs to be covered. You see that scenario, right? The price starts to go up, and then you're forced to buy, so it goes up even more. That's exactly what happened. But actually, that's not sufficient. From going to a very large short position to a short squeeze, you need a trigger. You need something unexpected, which could be a big flow in the wrong direction, could be an announcement like a war. You need something really unexpected, either in its timing or in its scale, for the price to continue to move up or to reverse or go against the short position. These three things are fundamental for a short squeeze. And we will see now that for nickel, these three things align in a way that's so beautiful and so perfect that it led to the exchange itself being completely caught off guard, the whole market itself and the structure of the market to be dismantled in a real systemic way that led to the market having to take this extraordinary, again, I can't stress that enough, extraordinary decision to cancel billions of trades, about $4 billion of trades over a whole day. So now let's talk about how we got to this, how these three pillars align themselves to have this massive short squeeze. But before we go there, you know the drill. I want to continue to do these videos. They take quite a bit of time, so I'd appreciate if you like them, obviously if you did. Subscribe to the channel, ring the bell, very important, so that you're aware of the next ones coming up, and leave comments. The first stage then, why was there a big short position? The owner of that big short position, the initiator of all of this really, was a company called Tsingshan in China, a large nickel and stainless steel producer. And the view of the company and his owner was differing from that of the analysts. The view of the analyst was that because of electric vehicles, there would be an increase in demand that the nickel producers would not be able to fulfill. Tsingshan, being a producer, knew that they would be able to fulfill that, and therefore the expectation and the prices that were building up, as we can see in this chart that's coming up now, that the expectation of the prices going up were not appropriate, and therefore that the prices would be lower than what they were building up to be. So he started to build a pretty large short position, reckoned to be about 300,000 tons of nickel, understanding that his production for the year was expected to be 850,000 tons. In other words, he was shorting only part of that production, about 35% or so of his production. So in financial terms, you could say he was net long. But he had this big short exposure, 300,000 tons. He actually, going into these few days, he had reduced that to 150,000 tons from what I could gather and get from the coverage. So now we have that big short. And that big short was done where? Well, it was done on the London Mercantile Exchange, which is where most of the trading is done for metal. Not that many metals are traded every day, and you can see the list coming through now. And they're done on the pit trading, actually, and electronic trading. It's a hybrid market of the London Mercantile Exchange. There was an attempt at reducing or eliminating pit trading because obviously during COVID, spitting at each other's face to agree on the price was not really popular. But the exchange members actually said, no, you need to continue to do that. Pit trading is very important for the price discovery. So we have a hybrid market, electronic and face-to-face, and that's where some of the shorts were, reckoned to be about 30,000 tons, but everything else Tsingshan had done through the banks, JP Morgan and many others, and brokers. So the banks were actually facing the market. Of course, when someone tells a bank, I want to go short, and the bank provides a way to be short, which could be an option or any other structure that they think is the most efficient, the bank on the other side has to reflect that position in the market. And then we had the trigger. Obviously, the trigger was when Russia invaded or attacked Ukraine. The consequence from a market perspective was that there were fears that it would stop the nickel exports from Russia, which obviously creates a big imbalance in production, and the prices should go up. And the prices started to go up on the anticipation of this, and that's why you have the third part that comes in, forced seller. When you get into a short position, you are not receiving money. You actually have to commit some capital to cover the potential losses of the short exposure. That's called a margin. On the exchange, that margin is described by the exchange rules. With the counterparty, it would be described by the counterparty agreement or the swap agreement or the options agreement or whatever agreement Tsingshan would have with its bank. But in any case, what's for sure is that you need some cash to support the position that you have. And as the position gets away from you and you lose more and more money as the price goes up, because you're on a short position, you need to put more and more cash. So now we're going to see what amounts we're talking about. I made some assumptions about the margin themselves because they change actually through the period. The numbers started a bit lower than what I'm going to show, and finish at about what we have here. So I'm assuming 20% margin for the position, which seems to be about right. So now we're seeing this chart, which shows the long position in millions of dollars. So we're starting with about $21 billion. The short position, which is $3.7 billion, big amounts. And the net exposure, which is 17 billion. The net exposure is the difference between the longs and the short. It's really what the remaining risk of Tsingshan is. So as we go along, we're starting from the 28th of February, and as you can see, as we go day by day, the position, everything is growing. The longs, the short, but also the net, because it's a net long exposure. And then on the 8th of March, you can see the amounts are just staggering. 85 billion long, 15 billion short, and 70 billion net long. So the Tsingshan at this point is 70 billion based on the production they were expecting for the year. They were long $70 billion of nickel at $100,000 for the price, which is what the price was printed on the 8th of March, because these trades happened. You can see on the chart, you can see that big spike up. Well, these trades happened. And then they were cancelled. But if we go to the margin value of all of this, and here we're talking about cash, so it started at 750 million, as I said, it's probably more like 500, and then it grew 1.5 up to $3 billion. At this point, Tsingshan could not pay the margin. It could not, it didn't have the necessary cash for it. Now remember, there's 70 billion, on that day, 8th of March, there's 70 billion long, so they actually made a lot of money, but it's paper money, if I could say that for nickel. And remember what I said on the second pillar, forced seller. Forced seller is exactly that. You don't have the cash to hold the position. You're unable to keep the short position, and therefore you have to buy. And whether it's you or the bank behind you that has created the structure, it doesn't matter. Someone is buying, and is buying in large quantity. And that is exactly why the price spiked up in this crazy way like this, because there were a lot more buyers than sellers. Because at some point you say, well, it's crazy. I'm not going to sell because I know the market is dislocating and there is someone with a serious credit problem and is being forced to sell. I'm not going to sell at 50,000 because I know the price is going to be 100,000 or whatever the price could be in the future. So only buyers and no sellers, and that's how you get crazy prices. We're at the end of 8th of March, or a few hours later, and the LME was faced with the real situation that some of the brokers actually could not pay those margins to the exchange for the exposures they had, which meant that many brokers would go bankrupt, which meant that the market would disappear. Because if you don't have participants to make the market, to take some risk, and to do the price discovery and so on and so forth, there is no market. And it became pretty clear at that point, at least from the LME's perspective, that if they allowed the price, the print of 100,000 or so, to stay, then it would just wipe out the market. So their decision was to go back to what they should have done the day before, actually, which was to cancel $4 billion of trades on the 8th of March and go back to the price that was there on the 7th, and to ask for the margin calls at that point and to see how the market was going to behave after that. So now we're going to go back to our chart, and I kept the scale the same, so you can see that by the 7th of March or 8th of March, you're keeping at 40 billion exposure and 25 net exposure. It's smaller than what we had, and obviously will have implications on the margin. And we're stopping here on the 25th of March. It continues to the market continues to try to find a balance, but we obviously have much smaller amount. And if we look at the margin value, and this is where it changes everything. If we look at the 8th of March, the margin value is less than 1.5 billion, which is half the 3 billion that we had before. And what happened at that point is that the Tsingshan was able to have an agreement from the banks, seems to be mainly JP Morgan, to actually hold the position. In other words, the bank financed keeping those shorts for longer, because again, if they kept the short long enough, the price would go back to more sensible levels, or Tsingshan will start to get cash from selling physical nickel from its production over the year and compensate for the short, and being able to pretty quickly actually being able to pay for it, because after all 1.5 billion is not that much versus the 850,000 tons at 20,000 that they were going to sell, which is 17 billion. So this is really what happened. You have this and why the market has since been trading kind of in a weird way, because the price discovery has been destroyed by this cancellation. The reality of Tsingshan is that they now can hold a position and will continue to finance it, but a lot of people have been hurt or have made money from this trade, and now they're trying to find some footing. Now, obviously, the aftermath of this is still being written. We have probably a few months before we know what's coming out of it. What's pretty clear is that how the LME got into this situation could have been avoided by looking at the size of the position by one participant. Now, there are limits on how short you can be in the market, and they were not touched in this instance. Probably because it was going through many different ways and different structures. And it wasn't really explicit in the market, and not explicit enough that the market would say, look, you're being too short, you're above some limit. That was one possibility. The other reality is once this started to play out, it could not be stopped. And that's why it's a market crash, and we will see that again and again as we cover others. At some point, it's just too big and it goes away from you. And then you're in a systemic problem, and all bets are out. It's typically a credit problem, a cash problem that hits market participants, and they just have to go with the market, which is going against them. Typical case here. Once it gets going, you can't go back. The market was not impressed. This is an industrial metal, as we've mentioned. It's traded between professionals who come into this market wide open. They know the rules. So for trades to be cancelled is really unheard of. Just a couple of quotes here. For the LME to cancel nickel trades between willing buyers and sellers is unforgivable. From Mark Thompson, which is a trader for commodity traders. Cliff Fastness, founder of AQR, large hedge fund, which we invested in probably day one, so many decades ago. AQR accused the LME, which was owned for century, started in the late 19th century, was owned by its members. In 2012, it was sold to Hong Kong exchanges and clearing. And Cliff Fastness accused the exchange of stealing money from market participants trading in good faith and giving it to Chinese nickel producers and their banks. Ouch. So that hurts. But in reality, I think we can say the LME didn't have a good possibility. We will never know whether letting these trades happen would have been better for the exchange in the long run. What we know is what they decided to do was exceptional, extraordinary, and it will certainly hurt for quite some time. So again, has it found its kryptonite? That's something that's very very interesting, and we'll see how that goes. Voilà, many thanks for watching. Subscribe, ring the bell, like, and please share your comments if you lived through these conditions. It would be really interesting for everybody and myself to have some insights as to how this went and how it's still going, and your views as to where it should go from here. That would be really insightful. Have a good day and keep safe.